Everybody misunderstands this or has a short memory. We said, and I remember it clearly because I came back from Zambia on safari, came back, did a video, Julie and I, Banana Zone starts now. That was August, September 2024. From then on, the market ripped higher and we chose various assets. We chose SUI, Solana, and we said these are going to outperform. And they did massively. SUI put on a 5 or 6x over that period. Then we said, hey, global M2 is slowing. We're going to see a correction. This is we'll call the phase 1 correction of the Banana Zone.
Raoul Pal talks about crypto and Bitcoin, sharing insights on markets, trends, and opportunities. Let's dive in and discover more.
That was phase 1 correction. That finished in April. Julian and I came on and said, by the way, this correction's finished based on our work on global liquidity and the markets are going higher. And the markets have gone higher. We said Ethereum will start to begin to outperform. Solana will come back. Exactly those things started to happen. We are now still in the early phase of phase 2. This is not a phase 2 correction. We've barely broken out. In fact, most other assets, thinking about stuff like total market cap, X, Bitcoin, and ETH, haven't yet broken. Now think of the Banana Zone here. All of these previous 3 were all only one period wide, this 1 year. This one will be wider. So which is why the market looks less parabolic at this stage. But the parabola will occur, and Julian showed you with that work earlier, and we will have a phase 2 correction later. Our general viewpoint is the phase 2 correction is either the one towards the end of the year when people think, well, Bitcoin traditionally tops here, I'm out, or it's a larger correction from March through till later in the year. It depends how long the cycle plays out. Because obviously that March onwards periods, again, if it continues to play out into the end of 2026, which is possible, not our highest priority yet, but if it does, then we'll have that period people say it's all over. But again, it's unlikely to be over. But we don't know that yet. All I know is the next correction will be phase 2 and not the final one, and that's likely into year end.
Robert Kiyosaki, the well-known author of Rich Dad Poor Dad, has once again made headlines, this time taking aim at Warren Buffett. Kiyosaki reacted strongly after Buffett, who has long criticized precious metals, made a rare case in favor of gold and silver. For decades, Buffett dismissed gold as dead weight, something that didn't produce income or create value like farms or businesses. That's why his recent praise of metals has caught so much attention, especially from those who see it as a signal of deeper financial trouble. Kiyosaki sees Buffett's shift as a warning that a major depression could be approaching. He openly admitted that Buffett's words made him want to vomit, but also insisted they shouldn't be ignored. For Kiyosaki, the takeaway is simple. The traditional financial system is weakening, and people must prepare. He argues that defensive assets are the only safeguard, and alongside gold and silver, he emphasizes Bitcoin and Ethereum as vital hedges for the future. The clash between these financial giants highlights 2 very different ways of interpreting today's market turbulence. Buffett, often called the Oracle of Omaha, has taken a step toward assets he once mocked. Kiyosaki, never shy about challenging mainstream thinking, views this as proof that the old playbook no longer works. For everyday investors, the lesson is clear. If Buffett is turning to gold, it might be time to rethink what's coming next.
So hopefully we've given you the full framework of understanding. We've gone back to the really big picture, demographics. We've gone through to debasement of currency, why your future's fucked. And now we've gone through to how it affects everything, the business cycle, how it all comes together, where inflation fits into the picture, where unemployment fits into the picture, how you think about asset allocation, why you're concentrating your portfolio, why it's rational that you're trading crypto and tech stocks, and you should be doing that. This is the way, if you follow a framework like this, using the overall structure of this, it will really change how you do things. You won't be lost in markets. You will lengthen your time horizon. You won't be asking me, hey, is this correction over yet today? I don't care. Look at the trend. We're 4% of the way there. We're going to $100 trillion. Your job is to not fuck this up. Not fuck this up means be careful with your asset allocation. Buy the bigger proven stuff. Generally top 10, top 15 market cap. Don't use leverage because you get washed out every time there's a correction. Expect pullbacks of 20, 30%. They're normal. That's the kind of volatility you will have to suffer if you want these returns, and you have to be comfortable with them. Then you need to not get hacked, do stupid stuff online. Don't lose control of your tokens. Use a ledger device. Use a multi-sig wallet. Do the things to not lose control of your tokens. Be very careful when you're using DeFi. Don't lose control of your tokens. If you lose control of your tokens, you're out of this game. The biggest macro trade of all time.
Yeah.
The scarring. Everybody is scarred because everyone has this framework that used to be around about the halving. Then it was like, and I still get the thing about the ETH blow off top that I was expecting last time around didn't get. I didn't understand this then. It's the work that we've done subsequently. You've always got to go and do the work when you're wrong to understand, okay, why was I wrong and what is the key factors? And people are still so scarred by this that I think it's going to fuck up people, because if we're right, the cycle extends longer. And if we're right, prices go further than expected, and it will not end this year. And I know everyone says, yeah, this time is different, sure. From all of the work that we do, probabilistically speaking, it's got an extremely high probability of going well into 2026.
In Nairobi and Lagos, stablecoins like USDT and USDC are no longer a niche experiment. They have become everyday financial tools. For freelancers, traders, and small businesses, stablecoins act as digital dollars, offering stability in economies hit by inflation, currency swings, and costly remittances. Amina in Nairobi can bill a client in Europe, receive USDC in minutes, and cash out instantly to M-Pesa. What once felt futuristic is now routine, blending crypto with the mobile money systems people already trust. In Lagos, the story is similar, but on a larger scale. Shop owners and entrepreneurs hold Tether to shield their earnings from the Nairo's volatility, using it to restock imports without losing margins. Nigeria alone processed nearly $22 billion in stablecoin transactions in a single year, a staggering figure that shows how deep the adoption has gone. For many, the draw is practical economics. Traditional remittances remain some of the most expensive in the world, often costing families nearly 10% in fees. With stablecoins, money moves faster, cheaper, and with little more than a phone, a lifeline in uncertain financial times. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoin Zella for daily news, all for free. That's all for today's video. Until next time.